Good afternoon and welcome to today's event. We are discussing today first preliminary evidence on how COVID may have possibly affected productivity at the firm level. I've gathered today a consortium of researchers who are participating in a research project called Microdata that is studying really the way that productivity is changing through bigger shocks, the China shock, and of course the technology shock that we are facing. But of course, COVID has put an interruption in our deliberations. But luckily, we have new data that is going to give us some new first feel of how COVID-19, the various shutdowns that we've experienced in all countries in Europe, have affected productivity at the firm level. I'm Maria De Mergis. I am the Deputy Director here at Bruegel, and I'm delighted to be joined by my colleagues from the various universities working on the Microdata project. We will start with an overview presentation on some of the recent results on productivity, and then we will zoom in on country data. We have country data for Germany, France, and Italy, and we will be hearing separately from them what is their understanding of how firms have been affected by the COVID shock. So let me first give then the floor to Filippo Di Mauro, who's joined us from Singapore. Thank you for joining us. Filippo is a little bit late for you today. Who's going to give us an overview of the first results on the productivity. Filippo is working also on the content data, so he's not new to productivity research. So with that lens, he will also be addressing the question at hand here, firm productivity and COVID. Filippo, you have 5 minutes for introductory remarks.
I thought it was 6. Anyway, thank you very much.
They reduced.
No, sorry. Outline for today is going to be, obviously, as you remember, COVID has disrupted all aspects of our life and clearly inflicted tremendous cost to the economies. And right now we have been talking very much about subsidies, the impacts on growth, but the impact on productivity will become eventually critical to ensure that the recovery going forward will be balanced and sustainable. So what do we know about COVID impacts after 1 year? So what I'm going to do is going to provide you a quick, simple conceptual framework and then indicate some results across the globe, and then again going to the colleagues that are for the country experiences. Let me start with a primer on productivity. So we start from the production function. The output is a function of labor and capital, but also of total factor productivity, which is the way we use these inputs. Now, how do we distinguish total factor productivity? But well, we have one part, which is the within firm productivity, which is basically what is internal efforts, characteristics of the firms like marketing, technology, cost. But then there are also other effects which are between firms, and this can be kind of distinguished also between a net entry effect, which is basically the new, more productive firms entering, as well as the bad firms exiting, and the second part, which is the allocative efficiency. That is to say, apart the entry and exit, how the resources, labor and capital are going to be used. Are they going to be going to the most productive firms, which eventually will become larger, and therefore there is going to be a good allocative efficiency? Let me present some of the evidence that we got in general, in the rest of the world and in England, and then going to our colleagues for Europe core. So first, on some data regarding the effect of within firm productivity versus between firm. Now, the effect on within firm productivity is very likely, and is actually shown here, both for total factor productivity as well as for labor productivity, going to be negative. Why? Because firms are losing efficiency, there are higher costs because anti-COVID measures, there is less sales with the same amount of employees. Clearly, the within firm is going down. But there is, in the analysis that has been shown by some firm level data for the UK, we may have had already some positive between firm effects, which are basically the idea that there are least productive firms and sectors which have been disproportionately affected and therefore exit, and therefore the aggregate productivity being somewhat maintained. So the bottom line of this picture is that between firms, productivity or effects attenuates the within firm that certainly is negative. So that's the first message out of the UK, right? So, but let's go into the net entry effect. So the issue that we are going to have for sure with COVID is lots of firms going out, presumably the small, and other firms entering. So we'll see what's happening, right? There are, however, encouraging strong effect for the US. Now, this is the data of 2020. So early part of 2020, end of 2020, the red line, against the 2015-2019 average. So in the US, there is actually a positive and encouraging business information trend, which is present. So it looks like a good thing. Of course, we don't know, still uncertain how this will be sustained and boost the future productivity growth. But again, this is another take-home message. In the US, there is some evidence that actually the net entry was positive with respect to 5 years before. Now let's go to some impacts within the firm. So basically, how the firms reacted, right? So how they reacted to this crisis. Well, we have some evidence which is based on survey on Spain. So this basically tells us that existing firms are clearly changing the way in which they are conducting business during the crisis, right? You can see here new ways of approaching. One important thing that is coming up is that the most common change that has been found in this survey is that remote work is a new thing, right? Which is presumably also productivity enhancing. Or there was no change. So again, the message in this picture is that remote work was a new thing that was introduced or no change. But the important thing, and this is the second picture here, is that whenever there was a change, this change actually was concentrated among the mostly largest firms, the biggest firms, and possibly the most productive firms. So again, there are changes going on. The within firm productivity clearly will be changing, but the engine of this change is going to be only the largest firm. So we'll see what is going to be the effect on aggregate productivity when we consider the overall impacts. Finally, there was one item that was at the beginning of the COVID very much on the mind of everybody, which is with the disruption of global value chains, you're going to have a drop in trade and in productivity. Well, the results actually were not so bad as expected because there were no generalized signs of supply chain disruption. These pictures basically show the GVC-related trade after the crisis went down for everybody in the first few months of 2020, but then there was a recovery, although somewhat diversified across Europe, negative in France, but with some sign of recovery in Germany, Italy, and Spain. So let me conclude with sort of some first preliminary assessment. Across the globe, possibly, so far, the impact of COVID on productivity was less damaging than feared, right? Because of the evidence that I showed you before on the global value chain, on the net entry, and so on. The most important thing that we know, that this was the first chart I noticed, was that there is possibly some cleansing effect going on across firms and across sectors. So the within firm productivity certainly went down, but presumably there are some least productive firms going out and better firms entering. So there is, however, a lot to learn, and particularly in the differentiation of the impacts across and within sector, several dimensions, such as sectors, cities, and so on. And it is not still unclear who are the new winners or losers from the crisis if we accepted the digital firms, that we know that they were big winners this time around. Data are still scarce, but as Maria was mentioning, Microdata, as well as Component, an associated network which I led, will be able to offer very soon some more systematic evidence, which is actually cross-country, because this is what we want to look at. For now, let's look into instead the evidence that my colleagues will be able to offer on 3 specific country cases. Thank you very much for your attention. Maria, you have again back the world.
Thank you very much, Filippo. That was great. Can I ask you, Filippo, just on one of your first slides, the within firm effect, there was actually two sort of opposing effects that could be playing out. One is a cleansing effect within the firm. Given the shock, you become more efficient, you reorganize and become more efficient. Or you have negative shock coming from just the lack of demand. And your evidence from the UK shows that it is the second one that dominates. Is that correct, the way I understood it?
Yeah, yes and no, in the sense that when we are talking about in this literature for cleansing effect, we are talking about between firm phenomena. Within the firm is basically what the firm has, has higher cost or has the same level of employment, say for lower sales, clearly productivity within firms goes down. However, at the aggregate level, when you look at the productivity of all the firms, as soon as you have some positive actually going on resources from the least productive firms to the most productive firms, and the most productive firms are becoming larger, getting market share, by the algebra of this would be the aggregate productivity will increase. So basically the bottom line of this is that within the obvious short-term effect is lower productivity, but however compensated possibly by this entry-exit phenomenon, which we call cleansing effect.
Okay, wonderful. No, that's clear. Thank you very much, Filippo. Okay, now so this is a kind of an overview of what types of things we'll be looking at. And why don't then we zoom into some of the country evidence? I suggest we start with Stefan. Is that okay? Take your time.
That's perfect. Okay, I assume you can see my screen. Good afternoon. I will talk exactly about the cleansing effect that actually Filippo nicely introduced, so I will not have to do this again. But the question is, maybe you could put it differently. You could say, okay, within all this catastrophe of COVID, right, is there maybe a hope that we go out of the crisis even stronger than we went in, right? So could there be a cleansing effect of this recession? And if so, how does government support actually interfere with this? So my evidence will be based on newly released microdata. There's a long-standing panel data set that now includes also COVID-related questions. I make it very short. This will be representative for Germany. It's establishment level, and I will exclude the public sector from today's analysis. So let's start with looking at who has been hit hardest by the crisis in terms of sectors. On the left-hand side, you see, little surprising, the top 3 sectors in terms of being really hit hard is the hospitality sector. So 65% of the plans in this sector say, okay, we have been really, really hit hard by the pandemic. And you should know that data has been collected between July and September, so after the first wave of the pandemic, but before the second wave. Then we see that personal services and education have been hit hard, whereas, for instance, the construction sector or mining has not been hit at all. Overall, 25% of the firm's plans responded to having been hit hard. On the right-hand side, you see a different measure. That's a question on whether you are close to market exit because of the pandemic. And overall, shockingly, 12% of the plans said, yes, we are actually close to bankruptcy and close to market exit. And if you look at the regional distribution, you see that urban regions are more affected. This is most likely due to the sectoral composition of the shock. And you also see that East Germany is a bit less affected, which might have to do with the fact that the East is still less exposed to the world market. So the GVC interruptions that we have seen in Germany do not affect the East as strongly as the West. Now let's look directly at what we can say about cleansing effects. So this graph shows you the effectiveness of the firms stratified by, and that's important, the pre-COVID productivity, right? So the productivity levels with which they entered the crisis. And I stratified here the productivity distribution into 4 quarters. And let's have a look at the dark blue bar at the very left. This tells you that among the least productive firms, about 1/3 said, okay, we have been hit really hard by the pandemic. Whereas among the top 25% firms, this is less, that's 20%, but wait a second, 20% is quite big, right? So 20% of the best firms told us, okay, we have been hit really hard by the crisis. So there is a productivity gradient in these two measures. So the close to exit margin looks similar. But we should never forget that also very, very good firms have been really hit hard by the crisis. Now I confront this with the take-up of government support schemes. So that's the very same graph, but now we don't look at who is affected. We look at whether a firm took up or used short-time work or financial government support. So about 38% of German establishments actually took short-time work and financial government support. That's a huge fraction. So the first insight is that the bars on the right side are much bigger than the bars on the left-hand side. So that's interesting. You also see that there is a productivity gradient in terms of financial support. So the least productive firms are much more likely to take up financial support. If you look at short-time work, and I guess I have to explain in a second what short-time work is, because it's so massive and maybe the most important support scheme in Germany. So this means very, very short that if you face as an employer a temporary shortfall in demand or a major catastrophe like a fire or what have you, then you can apply for money for actually the state will pay the salary of your workforce for a limited amount of time. And this scheme actually helped Germany a lot during the last crisis in 2009, where we barely lost employment and have been the first to recover because firms can retain their trained workers. And if you look at the take-up of this scheme, you see there is barely a productivity gradient. And importantly, I mean, all these figures here will have a between sector component because the least productive sectors have been affected most. But importantly, even if you take out sector differences, you will see the same patterns you see here, right? So there is also, it's also within the sector, the least productive firms that take up state aid and that have been hit hardest, with one exception. So short-term work is productivity neutral if you tease out sector differences. Okay, I have shown you without any government intervention, we would have expected cleansing effects, right? But I also showed you, well, at least in the short run, it was very important to safeguard firms because also very, very productive firms actually have been hit hard by the crisis. But for me, the question is more, okay, if the government support was indispensable in the short run, could it be dangerous and distortive in the long run or not? So this directly then refers to the question on phase-out policies. So I would like to use the last 2 minutes maybe to zoom into 3 schemes that are interesting. In March, at the outbreak of the pandemic, the German government decided very quickly that they would relax firms' obligation to file for bankruptcy, even if the firm is bankrupt. So you don't have to go to the court and declare bankruptcy. And this was a policy that lasted for about 6 months and has been reinstated in October. So we have a chance to already evaluate, looking at bankruptcy figures, whether there has been a major wave after the reinstatement of these bankruptcy filings, and there was no. So we can say within the environment that we had, uncertainty, massive state aid, this policy seem not to be distortive. That's the first thing we can say. Second, I showed you that various financial support schemes, many of them are ongoing, could be potentially distortive because they really went to the least productive firms. You could also say they went to the right firms because they have been affected most, but there is actually evidence that this is really, there's really a productivity bias in this support. However, there was no evidence, at least in 2020, that the short-time work take-up was productivity biased. This was productivity neutral. So this is good. However, the German government decided to extend short-time work until end of this year. And if we assume that there will be a recovery this year, then this scheme might be potentially distortive for factor allocation this year. So it might inhibit the growth after the recession. Thank you.
Great, thank you very much, Stefan. There's a lot of interesting things to discuss further. But before we do that, perhaps we can hear also from our other colleagues. Why don't we go to Agnès Benassi-Kéré, who's going to tell us about the French evidence. Agnès.
Many thanks. Hello, everybody. So I'm going to share my screen. Can you see it?
Yes, yes, yes. Thank you.
Excellent. Maybe I should put it in full screen, but yeah. Okay. So hello, everybody. I'm going to present recent simulations made on French firms. It's more than 1 million firms, and excluding the public sector and agriculture and finance. So this is recent work carried out by Guillaume Rouleau and Benjamin Adjibili, at the Treasury, and it was carried out within the framework of the Curie Committee, which is following the implementation of the public support. So what was done was to simulate the income statement and the balance sheets of initially solvent firms. It is very important, firms that were not insolvent at the start of the crisis. It's 1.8 million firms, representing 82% of the French value added, and the simulations go from March to December, so this is the whole year. And what is specific in this new work is that it's based on firm level data about activity shocks. So it's based on VAT statements, and it's firm level data also on the take-up of government support, short-time work, solidarity fund, which is directed to smaller firms, especially to smaller firms, although it was extended over time, tax deferrals and reliefs. So on a monthly basis, taking into account at the firm level the take-up of these different schemes. Then a number of assumptions were done for cost adjustments. I'm not going to detail this. So the idea is that we take the balance sheet at the before the crisis, and when there is a loss, cash is depleted. When it is completely depleted, then automatically there is an increase in debt. So this takes into account the easiness of running a new debt thanks to public guarantee loans. And then when assets become lower than debt, automatically the firm is supposed to become insolvent, although of course there is a lot of idiosyncrasies that may say that this is different, but this is the information we have. This doesn't mean that they go bankrupt. So they are, in the sense of Stefan a minute ago, they are close to bankruptcy, but close to exiting the market, but they are not exiting the market. There are ways to survive even when you are insolvent. So on the right-hand side, you have the simulation starting at end February with 0. So because we are talking about new insolvent firms. The black line is the counterfactual without a crisis. The dashed areas are the 2 lockdowns. You see, so if you take the red line, the solid line, it's without public support. So you see a very steep increase of insolvency for new insolvent firms. So it's a cumulated number from 0% to something like 6% over the first lockdown, and then it increases over the summer, and again during the second lockdown to 12% at the end of the year. And the dotted red line is the same cumulative number of newly insolvent firms, but with the government support. So we see that it's much below. It's still higher than the black line, but much below. And it ends at about half the proportion of newly insolvent firms without public support. So in a nutshell, public support has halved the number of newly insolvent firms over the year. So this is what is said here. I'm going to jump to heterogeneity. So, of course, there is an heterogeneity across sectors, across firm size, geographically, and depending on the age of the firm. So on the left-hand side, you have the results. So this is the cumulative result in December. So if you take accommodation and food, of course, so the green line is with no crisis. So there would have been something like 3% new insolvent firms in this sector. And the red bar is with the crisis, but with public support, and it jumps to something like 12%. And in between, you see the very, very large number without.
Agnes, I think we have. Is Agnes frozen? Okay. Okay, we need to wait for. I think Agnes has presentation is now frozen, and we don't hear from her. Perhaps we give her maybe 10 seconds. Well, while we wait for Agnes, maybe we can address maybe a couple of questions that are coming already from our audience. And there is actually quite an interesting set of questions coming in. I think one of the questions coming from Alex Code is directed to you, Filippo, because it's about US data. And he's asking, why is high business formation in the US encouraging? Probably these are low quality necessity entrepreneurs. You said something about this, but could you possibly elaborate a little bit more on what you meant by that?
So yes, we don't know. It's a good point. This is just a very preliminary evidence. It's not even some data that I collected. This is basically done by Chad Severson, University of Chicago, in a recent presentation. So yes, I think we need to wait and see what kind of business we are talking about. You perfectly taken the point.
It's actually interesting that there is also new Eurostat data that is coming out, although the latest refers to the third quarter of 2020, that for the whole year of the EU is telling the similar story. It's saying that while the level of business formation at Q3 of 2020 was actually very similar to pre-COVID levels, so it went down and then bumped up. Whereas the level of bankruptcies is based through the measures that are still going on is still at very low, much lower than pre-COVID. Which, at first hands, I can imagine it's encouraging, but do we know that these are not what I call forced business creation? I mean, it's as you say. I mean, but it's interesting to see, and there are big differences between countries there. It's not that it's the same story across countries. So the EU numbers there really mask interesting things happening across different countries. I don't know, Stefan, you have the latest data for Germany. What is the case in Germany there?
I mean, it's true. So we have seen a massive drop in bankruptcies, right? So we have less bankruptcies in 2020 compared to 2019, which already have been a year with historically low bankruptcy counts. So it's really a paradox, right? And at the same time, however, and that's different to the US, we have seen also a decline in new business formation, a decline, right? So we are below 2019 levels. And maybe, and that's the question that has been raised from the audience, maybe this is really a necessity entrepreneurs, and we have a social safety net in Germany, and people just do not go out and found very small, maybe unproductive firms that rather take up, unemployment insurance.
Entirely similar dynamics in Italy, completely similar. Very low bankruptcies, drop of new firms during the first lockdown, much correlated, then slow resumptions after September in the number of new firms. And then we are waiting for the last round of data with the last lockdown, where probably there's another drop. very much connected to the indicators of uncertainty and epidemics in the number of new firms. But
so
definitely similar than Germany.
So the firms in it, the new firm creation is still lower than pre-COVID level. Yeah, it's interesting because in countries like France and Belgium, which I think are also driving the average EU numbers, as you do have a pure return, a quick return to the pre-crisis level, which is, I think it's interesting. It would be nice to hear also from Agnes on this, if she finds a minute to come back. So if I understand, then the point is that that you're making, Stefan, is that there is also a welfare system that acts like a net. That is very much actually what we're seeing there, and it may be effective, distorting incentives for business creation in directions that are not necessarily welfare enhancing. I mean
that's a big question, right? And that's not particular, I think, to the COVID situation. I mean, we have seen in the US and also in Germany a long-run decline in new business formation anyway. So we are on a declining path for many years now. So this is maybe something to worry about. Let's see what the COVID pandemic is doing with these trends. I just learned from Filippo that we have seen actually an increasing trend in the US, and we now have to see what comes out in terms of employment and future growth out of these firms. So my first take on this is that in Germany, people wait, right? They can wait, they can afford to wait because there's a social safety net. So I would expect if we see an uprise in new business formation in Germany in the future, then the composition of this should be more positive compared to what we have seen in the US, because people then just found a new business not out of necessity, but maybe out of good ideas, right?
Yeah, of course. I remind you that to try and distinguish the effect on growth, it would be difficult given the recent package of 1.1 trillion, 9% of GDP package that is going to have a stimulant effect, or at least a supporting effect for growth. So it's not going to be easy to disentangle what is the fiscal stimulus and what is the productivity effect. But yeah, all of this is subject to research, and there's a lot of work to be done. I don't know if Agnes is still back. Perhaps we can go to Carlo while we're waiting for Agnes to rejoin us. And Carlo, can we perhaps hear the case of Italy and what we learned from your data? You are muted, Carlo.
Yeah, with pleasure. Okay. So you should be now see my presentation, right?
Indeed. Yes. Thank you, Carlo.
Okay. So very quickly, just an overview on the key messages of what I'm going to cover and what we did. So we do find, similar to what is happening in Germany, that common COVID shock is having heterogeneous consequences across industries and regions. And in particular, I'll focus here more on regional evidence in Italy, which is essentially linked to the industrial specialization. We are finding that there are two channels through which COVID shocks might have an impact on territories. One is related to potential GVC's disruptions, potential, but then we have to check whether this actually takes place. And then for sure, there will be also an internal disruption related to the industries that are more associated with social distancing measures and health protocols, and in particular, the hospitality industry is going to be mostly hit. The problem is that, of course, the hospitality industry and similar industries are not homogeneously widespread on the territory. So you do have this channel of sort of endogenous regional disparity that emerge based on historical industrial specialization, traditionally related to different type of reactions of economic reactions that then emerge thanks to COVID. Essentially, what we find is that if you're exposed to a GVC shock, you end up having a lower turnover, which is a short-term effect. But if you are more likely to be exposed to an internal health-related social distancing measure in terms of your activity, the higher cost that is going to induce, and given the characteristics of the industries, is higher. It's more likely to have a higher probability of default. Now, the point is that the first shock is reversible, the second one is less reversible, and therefore here you have more severe regional disparities, and I'll show you where this is going to take place in the country. Then the other piece of evidence that I'm bringing to this is something that is just under construction. So yesterday I got hands on the new data and put together a table. We have been able to match the firms that have received guaranteed loans, SMEs firms that have received guaranteed loans, with the probability of exit that they have thanks to credit risk assessment based on nowcasted data that we are having on their transactions level during 2020. And what I will point out is that the evidence on non-performing loans and therefore the number of guaranteed loans that are going to default is perfectly manageable for the country, which is reassuring news. But there might be higher potential impact on employment because, of course, these firms have small loans but are relatively labor intensive. And I'll try to quantify this. And this gives us an initial priority and, if you want, rank in the phasing out measures that we might want to put in place, as I will discuss in a few seconds. So first thing first, this is the correlation, graphical correlation, and then of course I have econometrics behind this, but these are local labor systems in Italy. So essentially, these are commuting zones. You can think as those as commuting zones, and then you can look how much every commuting zone is exposed to a potential global value chain shock. Clearly, the north of Italy is more exposed than the south of Italy because the north of Italy is more industrial, more interconnected. And what we do see that this global value chain exposure seems to be correlated to changes in revenues between 2019 and 2020. So there seems to be that the more you are exposed to global value chains ex ante, the more you have experienced a negative change in revenues in 2020, which is a short-term shock. And probably most of the firms that are experiencing the short-term revenue shock, especially in North Italy, have enough capital structure to absorb this. More worrying is the second type of shock, which is the internal, let's say, exposure to health risk measures and social distancing. So forced closures of your activities. This is calculated based on a detailed assessment of the health safety measures taken in every narrow industries, calculated according to national labor health systems. And basically, this gives us a metric that we, by the way, with Bruegel, we have also replicated for all European regions. And what you see here at the narrow level of territorial aggregation is that most of the local labor systems that face a social distancing shock are concentrated in South Italy. Typically, this is the hospitality industry, but not only, but mostly the hospitality industry. And as you see, this is also where most of the impact of potential default rates, so changes in default rate, are more likely to take place in the country. Now, these correlations are essentially derived from this diff specification with robust local area controls and time-varying controls for the evolution of the epidemic and the excess mortality at the local level. What we do find is that it is very, let's say, as you said, that there are these two types of shocks that take place. And the other thing is that it is very, let's say, misleading to think that health-related indicators such as the excess mortality are an indicator of the economic performance in a territory. We find no correlation at all between economic performances of the territory and the COVID-19 excess mortality. So basing your phasing out measures on how much a territory has been hit by COVID in terms of mortality, for example, is totally misleading. You should actually look at to what extent COVID has changed production processes all over the board, to what extent COVID has induced a shock on global value chains, and then work out the implication for the production function of companies, and therefore the impact, be it revenues or be it default probabilities. Moving to the link between loans and the phasing out of subsidies. What we have here, we have this analysis of million small and medium-sized enterprises that have received 150 billion euros in guaranteed loans with an average guarantee of 85%, more or less stable. This is 96% of all the loans granted to SMEs in the country. Then what we have out of it is just the loans granted to large firms, and of course, the firms that did not apply for a loan. So these are treated firms, if you want, treated SMEs. These SMEs employ around 6 million people. And based on the credit risk assessment for 2020, we can distinguish them between firms will remain safe. They are the large majority of them, and firms that were potentially vulnerable but have not been impacted by COVID because of those characteristics that I just mentioned before. And these are also a very large majority. Then we have firms that became vulnerable, were safe, but became vulnerable because impacted. Firms that were, say, safe and vulnerable and then became risky because of the impact of the shock. And then we have the two categories of zombie-like firms. So firms that are about to go because of the COVID shock, but can still maybe be saved. And then we have the zombies, where most of the default might take place. Now, if you sum the loans that accrue to the zombie and zombie-like, these are 22 billion euros of loans. And if you look at the loans at risk for every category of firm, because of course every category of firms might default. I mean, the probability of default is not necessarily zero, also for safe firms. However, in total, you get the ballpark estimate, which is around 9 billion euros of non-reimbursed loans. And even if you raise the numbers for zombie and zombie-like firms, as you see, you get into the low billions number, which given the overall size of the Italian banking industry and the overall reduction in NPL for the country, is a number that is perfectly manageable. Things become much more complicated when you look at the number of employees and you look at the employees at risk. These are the employees at risk because of the defaults. So we assume that these firms are at risk of exiting and they exit. We are not assuming the potential downturn in employment levels, so the downward adjustment. So this is a lower bound estimate of what we are having. And even the lower bound estimates talks about 500,000 jobs at risk in the country, which is something that is in a way more sensitive in terms of impact than the NPL problem. So that clearly tells us what priorities should be for the phasing out measures. Just to sum up, what we find is that, of course, larger firms in our sample have received the vast majority of the funds, while the very small firms that are 76% of the sample in terms of numerosity have received only 23% of total funds. So that's a standard Pareto rule. And we are now looking at rough measures of productivity, so sales per worker. But if these are the numbers, we already know that probably the loans have gone in line with probably somehow in line with productivity, but I'll confirm that very soon. As I said, I just received those numbers. I'm playing with them, but we do not see particularly strange distortions in the allocation of the grants in terms of productivity. We do confirm that the hospitality industry is the most affected. 23% of total jobs actually come from the hospitality industry, which only represents 12% of firms and only 5% of loans. But the hospitality industry is 28% of all zombie-like firms. So I would say that the hospitality industry is clearly the most impacted, but this is also in Germany and in France, so this is not surprising. As I said, the impact on NPL is going to be limited. The impact on employment is potentially of a different order of magnitude. So that's it. Basically, that calls for, as the Germany has done, to postpone the short-term work schemes as much as possible in the future, while restoring the profitability of existing firms and then adjusting on the labor dimension only at the later stage. That's essentially the most important policy implication that stems from my data. Thank you.
Yeah, super. Thank you very much, Carlo. There's a number of questions coming from our audience, but before that, I'd like to go back to Agnes. Agnes, why don't we put the slides up and you tell us, we'll tell you where we lost you, and then you can pick up from there. There's also questions coming from you, Agnes, on the French data, which is interesting.
Yes. Many thanks. I'm really sorry about the inconvenience. So if you can go back to slide 4. So I already presented the aggregate numbers, and just to give you an idea of the heterogeneity. One is across sector, so it's slide 4. You have the results for each sector, and you see that accommodation and food is especially impacted. The green is without a crisis, the red is with the crisis but with the support, and the blue is without support. So it goes up to almost 30% of new firms becoming insolvent, which again doesn't mean that they go bankrupt, but they're insolvent, meaning that debts are higher than assets. At the end,
Katja, can you put slide 4 up? Your slide 5.
Yeah, slide 4. And then on the right-hand side, you have for different categories of size. And the basic message here is that, like previous speakers, smaller firms are hit harder if you include both micro and SMEs. And with the support, the hit is less. And what is important on this graph is to see the difference between support that goes through short-time work. So the yellow bars are with only short-time work, and the red line is with everything. And we see that for larger firms, there is no difference between the two, meaning that the support goes mainly through short-time work, which is more, of course, more friendly to larger firms. Whereas for micro and SMEs, there is really a difference between the two, meaning that on top of short-time work, the specific transfers to firms is quite stabilizing. Then next slide, 5. So on the left-hand side is by age, so it speaks for itself. On the right-hand side, you have the geographic impact of the crisis with the public support. And so you see some areas with specialized in tourism, also in aircraft industry and car making. Then maybe the core of the discussion today is about the cleansing effect. So it's slide 6. So on slide 6, you have the distribution of labor productivity. The black line is for the total sample of firms, so 1.8 million firms. The red line is for those firms that would have become insolvent even without a crisis. So like usually the labor productivity on average is lower. And the blue line is for those firms that become insolvent due to the crisis, that would not have become insolvent without a crisis. And it's in between. So meaning that we have a cleansing effect. So those firms are on average less productive than the whole sample, but it's less, the cleansing effect is less efficient than usual, meaning that they are on the right-hand side of the red line without a crisis. Interestingly, the dotted line is when there is public support, whereas the solid line is without public support. It's, well, the two lines are almost the same. So it means that the public support doesn't distort the distribution in favor of more productive or less productive firms. I must say that this is within a sector size group of firms. So if, for instance, you think that in accommodation productivity is less than in the rest of the economy, this is already controlled. So you cannot see it. So we don't have the rise in productivity that could come up from a reallocation of factors across industries. And finally, I just wanted to point out a result we have on the intensive margins through investments. So the debt overhang, we estimate the debt overhang, and then we estimate the impact of this additional debt on investment, and we find an order of magnitude of -2 to -2.5%.
Okay. Was there something you wanted to say on slide 7, the debt, additional debt and investment losses?
Yes, this is what I just said. So this is slide 7. We estimate the additional debt through our simulation, and we estimate through some economic estimation, we estimate the impact it could have on investment. Interestingly, we don't see any impact on R&D investment, but we see an impact on fixed capital investment of the order of magnitude of -2% for the debt that was generated over year 2020.
Yeah, Great. No, that's clear. Sorry. Thank you. Yes, there is a question coming from Eric Bartelsman, who is also part of Microprod. He's directed to you, and he's asking whether we know anything about the effect of the shock on mitigative actions taken within a firm. Is there a positive effect as a result of going digital quickly?
Yes, so this is a different work that has been carried out and is quite impressive, actually. So we've estimated the impact of the impact of being digitalized on, for instance, the retail trade, and we see a difference of 25% in terms of turnover between those shops that were already digitalized before the crisis and those that were not. And we really see, so it's an extreme difference. Those that were already digitalized performed much better during the lockdowns. And we really see an acceleration of the digitalization. Also in the recovery package, there's a lot of financing for SMEs to accelerate the digitalization.
Okay, that's very interesting. Yeah, that's yeah, it makes sense actually. Yeah, you can see how this works out actually. I wanted to bring in another question because it comes from a different country, just to get the multiple countries' views. There's Dan Freeman who's talking about the Dutch case, and he's arguing that we see a drop in the Netherlands, we see a drop in bankruptcies, but a rise in voluntary firm exits, i.e. exiting the market without necessarily filing for bankruptcy. Do you have something like, do you see something like this in your respective countries?
I can answer this easily. So in Germany, we have seen a decline in bankruptcies, as I mentioned before, but we also see a decline in voluntary exits as far as we can observe it already in the data, right? So the data goes back to November, December, and we see that also the exits decline. There will be different data sources, so I don't have any information on firms that employ workers. So this is all firms. So it could also be the shops that have just no employees. But so we wait for new data that would tell us also about the size of these firms. But we see a decline in exit, also voluntary exits.
Okay, so by contrast to the Netherlands, where they see a rise in voluntary exits, and what type of factors would imply a decline versus a rise in a voluntary exit?
Well, I think we see currently a great degree of uncertainty first. So you should know that many firms actually entered the crisis at the end of a long boom period, right? So there are actually buffers in the firm, first of all, and many actually expect that there will be a sharp recovery later on. So we have evidence, for instance, that households saved a lot of money during the pandemic, and they did not do precautionary savings. They just could not spend the money. So they're ready to do it. And firms will actually wait for this new, business, for these new sales. And maybe that's the reason that firms actually say, okay, we have buffers and we wait until it gets better.
Okay. I don't know if Carlo, Agnes, did you have any views on the subject, given your data set?
No, this is an interesting point. I don't think we can capture that at otherwise than just anecdotal evidence. What is a bit puzzling in our data is the relatively high, meaning 2-digit percentage of firms that were already insolvent prior to the crisis. So it seems that well, of course, you can be insolvent, and to the extent that you are not short of cash, you can continue. And also, there is probably love money that is quite widespread for smaller firms. And finally, there is something we don't capture, that is with the relationships with the customers. You may have some good prospects, but still, it's interesting to see that in normal times, and I didn't have these numbers in mind before I started to study it, that you have a number of firms, and this has to do also with the zombification of the economy, maybe, that look like insolvent even in normal times.
Yeah, indeed. Yeah. Carlo or Filippo, any views on the subject from your experience with the data you've looked at?
Well, we do not have yet information on. I just got the numbers on the net variation of firms. So I know that the numbers have been declining and then recovering, but I do not have the difference between new firms and exit. So I don't have the details yet of these differences, or how many new, if it's less firms that are entering with a standard exit of firms, or if it's instead new exits and standard new firms that are arriving. So this is still something that we have to investigate. And of course, it will be important. We are trying to see, we are relating this to uncertainty dynamics, as I think uncertainty is playing a key role. And Stefan is saying people are waiting to see what is going to happen. And also during the pandemic, they were, let's say, of course, stopped on their new ventures. So we do have a lot of territorial variation in uncertainty levels. However, we are playing with big data through local news, and we are running this algorithm of local news on Facebook or local press, and we do see that there is there are these indicators of uncertainty that you can gather from this big data, and there is some province level variation in how much the local media pushed forward with this uncertainty thing. And we're trying to see, and there seems to be a correlation between these uncertainty things and the variation in the net number of firms. So we are now trying to use this as an experiment to see to what extent uncertainty and new firms might be related in the future. So I hope to have more data soon on this, as soon as the new data arrive.
Yeah, indeed. That's very interesting, actually. We'll be delighted to hear the outcome of this. I'm aware that we're coming to an end, but there is actually a question that came in from somebody called Samia, who's asking actually a very big question, given the results that you have all presented. And they're asking, since there is a present cleansing effect, given that some of the high productivity firms are the ones that have been affected the least, I should say. Would you say that this also promotes competition and ensures the concept of survival of the fittest? Stefan.
Well, I have to go first. I mean, the special issue about the COVID pandemic is that, I mean, everyone was hit. There was no, selectivity of the least fit, right? In terms of that makes a difference. On normal times, we would assume that firms that go out have been the least productive before. So, and this is a good process, right? Then there is an increase in concentration, but this can be good, actually. I know that Filippo could answer to this because we have seen this over many years, right? We have seen a rise in concentration in Europe, and Filippo has a new paper with colleagues showing that this, at least in Europe, seems to be positive in a sense, because we have seen this cleansing effect going on. So that this concentration means that the more productive firms get bigger. So if this is the outcome of concentration, then it's good. If you have market power instead as a result of concentration, it's bad. But maybe Filippo, you would like to say more about this.
Maybe if I can say something on this. So our data show that small firms in proportion have been better protected. They have been hit harder, but have been better protected than larger firms. Also, young firms have been quite well protected. And what we have seen also, I forgot to say that, is investment, especially investment in intangible, has surprised on the upside during the year. So this could be also a good, it could be also a cleansing effect in terms of within a category, those firms that are able to innovate will eliminate those that are laggards. So in that sense, it could improve competition in the sense that this is innovation across the board, different kinds of firms, different categories, not just the larger firms.
It's just that, Stefan, when you presented your numbers, it was quite interesting that you said that it is the least productive firms that would affect the hardest, but they also receive the greatest support. And then the question is this good or is this bad, right? And that of course is a very, that's why this question is not an easy question to answer, but it pertains directly to the problem at hand. I mean, if you interfere with the natural process, is this a good thing or a bad thing? And you have to have a view on this because you're putting public money into that. But it's interesting to see that, because you mentioned both sides of the problem. The hardest hit is the least productive, but also they're the ones that perhaps do not deserve to get the money. But okay, this is not an easy question to answer. I appreciate that.
I think one thing that we might want to take into account, I think Stefan hinted at that at the beginning, is that this crisis is going to have a very different effect in ways that we still do not control in terms of heterogeneity of the impact. Because saying that the hospitality industry has been hit the most, that might imply that some productive firms have been hit in the hospitality industries, while other relatively less productive firms in other industries more protected by the COVID shock have been less hit. And even if within the hospitality industry, if you have a relatively less productive restaurant on the beach, you are for sure more protected by the COVID shock than if you have a big starved restaurant, very productive in the center of a city because of the nature of the shock. So what the new normal is going to be in terms of the ripple through effects of the productivity shock, we still do not know. And this is a big question because, as you said, Maria, we have to tailor, the phasing out measures based on some efficiency notion that, however, is still very far away from being clear because of the heterogeneity of the different shocks that we might see. Like cities in Germany most hit, West Germany most hit. In Italy, it's relatively easy. Okay, it's the usual South Italy that is going to be most hit, but okay, because of a combination of reasons. But even the North Italy has been hit in terms of turnover. So we have to see what the new normal is going to be. I think it's still relatively early to say, and therefore taking phasing out measures.
Yeah, and why this seminar is not the last word on the subject, and we're going to have to look much closer on this numbers.
Definitely.
But Filippo, I think you will give you the last word for one last thought, because we have already exceeded the time. Yeah, you're muted, Filippo.
We are certainly in. We have seen that is a work in progress. I think what we are doing now in Companet is that, of course, the country aspects are very important, but we need to find minimum common denominators out of that, right? So, and this is exactly what we are doing right now, really nailing down, not going too much into the specific, but understanding really, for certain aspects like subsidies or the sort of help of the government in terms of credit, how this compares to productivity or to growth of firms. So whether the good firms have been getting the right amount of help and so on. So this is something that, again, is work in progress that I promise in a few weeks and months we'll be able to. So this is an announcement for a next meeting, I guess. Soon, in order to, and I encourage also the audience, if you have any issue that or any data that actually you want to share with us, or some analysis that could be actually helping us out to build this minimum common denominator across Europe, because this is what we want. We want to understand how the continent per se has responded. I think I encourage you to send a message to Microprod or Companet and doing so. So thank you very much. Sorry, Maria.
That's great, Filippo. And with that, let me also extend my many thanks to Agnes, Carlo, Stefan, and you, Filippo, for taking the time to join us today. Thank you for putting this effort to present your preliminary results. This is not the last word. We will be back with more. So for the moment, thank you and see you soon.
Bye-bye. Bye-bye.
Bye-bye.
Bye, everyone.
Bye-bye.
Thank you.
Oh, thank you.
Bye-bye.
Bye.